Hello guys, and glad to have you on board again today. I think we need to debrief this latest Fed meeting, even though I personally couldn't find the time to look at the press conference in its entirety, which I normally would like to do in such pivotal moments. But I think from the external information that's been released and all the quotes that I was able to gather, there are some things we need to talk about. So we're going to, of course, look at the charts first and try to give any rational sense of what's next, also accounting for those things that have been said and stuff like that. Because I think I've gotten it wrong with some of the assumptions that I had personally back then. One of them being that we would get an announcement of 50 basis point rate hikes, and I still think this might be on the table, but some other factors that I not necessarily anticipated seems to have played out. And those are particularly one very important sentence that has been taken out of Jerome Powell's comments and intervention on the press conference first part, is that he says very clearly that the market needs to be ready to figure out a higher level of interest rates than earlier expected. It also says something that really stood out to me, is that right now we have kind of a three-factor set, which is people just trying to figure out when the Fed's going to pivot, which is one of those three factors. And the Fed clearly insists on the fact that this is really a set of three things that will matter net-net. The first one being, of course, the pace at which we rise interest rates. Very interesting. That's the one I've always been focused on. The second one being what the people call the terminal rate, basically when the Fed is going to find its pause stance, which means until major changes pushes out, the Fed will say it, okay, call it done, we've raised interest rate and we're going to stay there for an extended period of time before considering eventually releasing, which is how long we stay there. Okay, so there is the pace at which we get to the final rate, there is the final rate level itself, and there is how long we're going to stay at this final terminal rate before considering eventually even slashing interest rate to support the economy. If there is any need, of course. I mean, cutting interest rate can only be triggered from external factors of an economy deteriorating significantly. So what they said is that basically, no matter what happens, we're not going to lower interest rates until a significant period has happened. So 3 is going to be, don't think of it, folks, we're going to go up and down. It's not going to be the case. We're going to go up and we're going to stay there even if the economy deteriorates. We're not going to follow until there is kind of a lagging period in between. Okay, so that's one important factor. The terminal rate, they said it clearly, we might have to go higher than anticipated, though that's really not so dovish, or at least not so supportive of a tremendous bull market stuff. And the first one being, oh Jesus, really? Drilling right now? God damn it. Okay, give it a second. Okay, I hope they're done with this. Though anyway, and the first factor is the one I currently focus in a lot because that's the one the market pays attention to now, is the pace. So I still agree on the fact that the market sent a message earlier last week's to say that we are now going to have to switch to 50 basis points, folks, okay? Do whatever it is that you want, Jay, but the thing is that you're going to have to slow down to 50 basis points. So, okay, here they are again. Anyway, so 50 basis points is the new message sent by the market, and like I've always said, the Fed might be talking a lot and talking out loud, doing and playing the politics, but the reality is that for now they've been following the market, and until this changes, which so far doesn't seem to be the case, there are of course significant changes that the market sent a message for 50 basis points up until further notice, but that doesn't mean, okay, that's projecting what I said. So we've probably done the latest 75 basis point rate hike, which means the pace, the number one, is kind of going dovish now. We're going to just reduce, but reduce doesn't mean stopping, which means that second has gone more hawkish. So in that perspective, we're going to have to go higher. We're going to do it at a slower pace, which is kind of a good sign in terms of first derivative of momentum, in terms of basis points per day that the market will take. So it's going to be better on that end, but it's not going to be better in the second stage, which means we might have to go higher than earlier anticipated. My personal stance was we're probably going to go 4.75 basis points. 4.75% up to a maximum of 5%, which I thought would be the terminal rate. But the terminal rate has been said to probably going to go higher than the required. And this is where it trickles down to some problems to me. Because if I zoom out to the longer scales and stuff like that, here are the historical levels, okay? So I've always made it clear when we were back then, this was stupid bullshit. We're going to have to raise interest rates, and we're going to have to raise them to at least 3%, which was bare minimum to me. So it was basically this. I said minimum would be 3.25 because we're going to have to break this, and we're going to have to find the terminal rate in between this and that. The thing is that I never thought we would be able to break the 5.25, which is basically the market top of rate hikes in preceding to the 2008 market crash. Though I've always said we're going to find some ground in between, okay? There was no intermediate resistance that was meaningful enough. So in that perspective, I said, I don't know where we're going. I think this could probably be broken. This is what we have broken recently. But I don't know where we're headed, but we're probably going to stop in this area. So this was my personal targeted final rate. But the fact that the Fed clearly said we might have to go higher than anticipated, I'm really starting to question whether we might eventually try to break the 2008 as well. That is not my personal favorite, but I would say I need to be ready to consider this as a viable alternative. And if that's the case, then there are still several 50 basis points in a row to come over. There will need to be one at the next meeting, another one, which will consist with this one, and that means a third one, and then a final 25 basis point hike to get to this 5.75%. That's also kind of a staggeringly high level. Remember that the Fed #1 target is to get the Fed funds rate above the PCE, and possibly and luckily to get that PCE number starting to head down. Though in that perspective, what they're actively saying now is that we're going to slow down the pace. Yes, but the thing is that until we get to cross down or to cross over with the Fed funds rate down to the PCE, on the other hand, we're not going to stop and not even thinking about stopping. And what they said is, looking at the current projections and models that they have, the final terminal rate might have to be higher because the inflation doesn't want to go down. And in that perspective, if that's the case, and like I said, we're not going to go at the 2008 level. It's never happening, even though I don't really like the idea of making technical analysis over the Fed funds rate. It still means that we can do technical analysis on the 10-year yield, and I see very limited chances for the 10-year yield to stop right at an historical level. So either we fail below or we're going to have to break above, but definitely can't stand in the preceding historical prices. That doesn't make sense to me. So in that perspective, like I said, either we're still targeting the 5% and we're going to be done, but that can only happen if the PCE deteriorates below that threshold, so that the Fed can eventually say, okay, we're done for now, and we're going to assess if it goes down again, then we're done, and if it goes up again, then we start again. Okay, that's really what this is all going to be about. The Fed's going to follow inflation. If it goes below the target rate, then in that perspective, they're going to start eventually thinking about slowing down when they're going to have consistent signs that this is over. Otherwise, they're going to overshoot, which means they're going to try to go higher so that they have some room to work with. And in that perspective, if this is the mechanic they're using, I think 5.75 is going to be my new target rate. So in that perspective, positive signs on one end, negative side on the other. I don't think that's tremendously bullish for the stock market. I've made it clear before we get to that FOMC meeting, the VIX is still trading neutral, which is pretty good. We're in the middle of that area, so I don't think the stock market is going to overreact to bullish or bearish or stuff like that. I think we're in neutral area in terms of S&P 500. And the VIX clearly says, well, we might have a bit of volatility, but despite that, the volatility should still cool down. But that doesn't mean the market rises up and stuff like that. At 25, we still have elevated levels of volatility or implicit volatility. When it comes to the junk bonds, things are still pretty wacky out there. So the thing is that as long as we don't get out out of this area, there is definitely not a clear sign that we're past the worst case scenario. The euro dollar, same thing. As you can see, we're trading in the bottom of that area. I do think that we're going to get a rebound, but like I stated the other day, I don't know how the structure of that thing could be. All I know is that this is the area necessary to sell, the context basically, and it's going to take some time for us to get there because there is not tremendous push to the upside for the euro dollar. It's more like there's no room to the downside. We can't force our way down, so we're probably going to have to range and eventually find our way into getting back up there. I'm not considering buying anymore until we get to 96 or 0.96. I'm not considering selling until we get to at least 0.3. So basically, this is the new strategy. The USD/JPY still trades sideways and could take a hard hit. I personally think this one is a huge gamble, and we're going to see how long it plays out. Same thing goes for GBP/USD, but like I said, don't go too aggressive on these two. They're very dumb at the moment. On the other hand, we've also mentioned the fact with the French guys that what I'm going to be paying a lot of attention to now in terms of S&P 500 is that as we've been trading out of that neutral area, we've been rejecting, as well, I thought it would be the case, but now I think we're going to oscillate back there again and kind of neutral tainted oscillating across the 38% Fibonacci. So I think the current prices are actually interesting in my personal opinion. And I'm going to consider loading up some future trades again. But that's basically all there is. In my personal opinion, at the current stage, the market isn't going to break a resistance because as long as there is uncertainty regarding the inflation numbers and that final target rate, there is the risk for this target rate to be higher than anticipated. And in that perspective, we'll still have probably 1.75 basis points to take. And that's still a lot for the economy to take in. So I don't necessarily think that this is an appropriate time to be joyful and bullish like crazy. I think it's an appropriate time to say we've been way too bearish, way too bearish. So buying the dips in here, yes, I really didn't hesitate too long. But the thing is, going bullish immediately now before we can settle that target rate with more precision is going to be a tough time for the market. So I think we're going to have to spend a few weeks in here, in these areas, trying to figure out what's next. Though in that perspective, the next very important timing is going to be the CPI number, even though the Fed doesn't look at these ones, and definitely pay attention to the PCE. The market does know there is kind of a weird correlation between these two. So of course, CPI numbers, in my personal opinion, will be an interesting timing. We'll see, but I would like to see the market going right back up again with a positive stance before the CPI. And of course, if CPI is good, we're going to have the keys to break a resistance. If not, then of course, not there. So considering it that way, this is the area in which speculating is complicated. If you're speculating to the upside, I think this is the area in which you partial profit take, just in case the numbers are bad. For those who, and you keep a bit of that dry powder in just in case if things go well, because things could definitely do well. If you're a bear case scenario thinking that, well, this was just yet another of those bull rallies in a bear trend, then in that perspective, when we go back to the CPI, you get to sell with a stop loss and you get to see if the market deteriorates further down. That's really basically the stance. Pick your side. Like I said, don't try to be among the ones who gamble their way into being right. But basically, the thing is that pick a side. And if you're wrong, take a stop loss, move on. Just don't try to gamble your whole life on these types of things. So really, that's going to be all about it for now. The 10-year yields tend to suggest that for now, we're really switching to 50 basis point rate hike, which is going to give a breather to the market. But that doesn't change the pressure there is on the stock market itself if the number 2 on that equation of three-sided stuff is deteriorating proportionally. So in my personal opinion, if we're going to have to add up to 5.75, then in that perspective, that's not necessarily the time to be too bullish. That's the appropriate time to balance these things in and out, and that's probably more likely going to create some kind of a range. So I think right now the speculative areas are on the 1 hour context, which is basically when we get there, it's not going to be sufficient enough to pass through. When we're going to get below these areas, we're probably going to find a lot of support because there's no reason to sell on these supports. So it's basically we're going to oscillate across the 3800. It's just my personal favorite. And of course, the CPI will be the dealer. So if we get in that area before the CPI, I think that's entry point for the bears. the area in which we're currently in, meaning that the bears are trying to accelerate, overselling the momentum, I think that's the moment in which the bulls are looking for supports. So I think these are the areas that the bulls will look to buy, okay? Not necessarily immediately. We have some early signals that are not that bad, but I still think we can try to deteriorate further a bit. But the thing is that once we found that bottom, of course, do your job, try to find the speculative areas, no financial advice. And in that perspective, I think buying, partial profit taking before the CPI is basically the way to go for me until further notice. Of course, the next big ganger is going to be the FOMC meeting at mid-December. It's still far off from now. And in that perspective, no, it's the 14th. Sorry about that. All right. So this is what it is, okay? No, sorry, not that. Though the next FOMC meeting is going to be crucial, and in between, particularly pay attention to CPI and PCE. The unemployment numbers can still matter as well, but I think there are less of an impact on the market. That will be the CPI and PCE numbers. CPI, if it is in line with the consensus, not going to change the game, but I think the market has a slightly more positive upside potential due to the fact that we've locked and reversed that pattern over the higher time, the preceding lower points. So I think the market is on the recovery mode now, but needs confirmations from the data sets. That's all you need to know. Bye, guys.